My name is Alex. If you're tuning in for the first time, make sure to hit that subscribe button on this channel right now. It's free, and you'll get all the latest updates on market crashes, precious metals, and investment strategies straight to your feed. Don't miss out. The world's economy is moving fast, and knowledge is power. Today, we're diving deep into one of the most shocking events in recent financial history, the simultaneous gold and silver crashes of early 2026. This isn't just a blip on the radar. It's a seismic shift that wiped out trillions from the global market. I'll break it down step by step from the euphoric highs of 2025 to the brutal plunge we've just witnessed, and I'll reveal exactly how much value was swiped, yes, wiped clean, from the combined gold and silver markets. Buckle up. This is going to be a detailed ride through the chaos. We'll explore the historical backdrop, the economic drivers, the minute-by-minute mechanics, the human stories behind the numbers, the global ripple effects, and even some speculative theories on what caused it all. By the end, you'll have a crystal clear understanding of why this matters to your wallet, your investments, and the world at large. Let's set the stage properly. Because to appreciate the magnitude of this crash, we need to rewind a bit and understand the allure and the role of precious metals in the global economy. Precious metals like gold and silver have long been seen as safe havens in turbulent times. They're not just shiny rocks, they're stores of value that have protected wealth for centuries, dating back to ancient civilizations, where gold was used as currency in Egypt and Mesopotamia over 5,000 years ago. Gold in particular is the king of commodities, often called the ultimate currency, because it doesn't rust, corrode, or lose its luster. It's inert, scarce, and universally desired. Its density and malleability made it ideal for coins and jewelry, and today it underpins central bank reserves and investor portfolios as a hedge against inflation and currency devaluation. Silver, on the other hand, plays a dual role. It's both a monetary metal, much like gold, and an industrial powerhouse, used in everything from solar panels and electric vehicle batteries to medical devices, photography, and even water purification systems. Silver's conductivity is unmatched, making it essential in the electronics industry, which consumes about half of global supply. Fast forward to the economic landscape leading into 2025. The world was still reeling from the aftershocks of the COVID-19 pandemic, supply chain disruptions, and escalating geopolitical conflicts, including the Russia-Ukraine war and tensions in the South China Sea. Inflation had spiked to levels not seen since the 1980s, with the U.S. Consumer Price Index hitting 9.1% in mid-2022 before gradually cooling but remaining stubbornly above target at 3 to 4% through 2024. Central banks, led by the Federal Reserve, had hiked interest rates aggressively to combat this, but by late 2024, cracks were showing. Recession fears loomed, stock markets wobbled, and cryptocurrencies like Bitcoin experienced their own boom and bust cycles. In this environment, investors turned to gold and silver as flight to quality assets. Gold's price stability and silver's growth potential made them irresistible. In 2025, these metals were on fire, igniting a bull market that rivaled the greatest runs in history. Gold surged over 63% for the year, smashing record after record and climbing to new all-time highs, surpassing $4,000 per ounce by December. This wasn't hyperbole, it was driven by real forces. Central banks worldwide purchased a staggering 1,037 tons of gold in 2025 alone, the highest annual total on record, according to the World Gold Council. Countries like China, Russia, India, and Turkey were aggressively diversifying their reserves away from the US dollar, which had been weaponized in sanctions against Russia. China's central bank alone added over 200 tons, citing de-dollarization as a strategic imperative. Meanwhile, inflation fears persisted, with global averages hovering around 4 to 5%, eroding the purchasing power of fiat currencies. Geopolitical tensions, US-China trade wars escalating into tariffs on tech and rare earths, plus ongoing Middle East instability, drove safe haven buying. Retail investors, empowered by easy access platforms and social media, piled in too. Platforms like Reddit and Twitter, now X, buzzed with communities like r-Silverbugs and r-Gold, where stacking, accumulating physical metals, became a mantra. Silver? It was even wilder, rocketing up 144% to 149% for the year, its strongest performance since the infamous Hunt brothers cornering attempt in 1979 to 1980, when the Nelson Bunker Hunt and William Herbert Hunt tried to monopolize the silver market, driving prices from $6 to $50 before a brutal crash. Investors were piling in, driven by the same inflation and geopolitical factors, but silver's industrial demand supercharged the rally. With the global push toward renewable energy, silver consumption in solar photovoltaic cells alone jumped 20% year over year, as panels require about 20 grams of silver each. Electric vehicles and 5G infrastructure added to the strain, creating a supply deficit projected at over 150 million ounces by the Silver Institute. Meme stock frenzy spilled over. Retail buyers, inspired by the GameStop saga, organized silver squeezes online, buying physical bars and coins from dealers like APMEX and JM Bullion, which reported record sales. By the end of 2025, gold had returned over 60%, with prices pushing past $4,000 per ounce and silver crossing $100 for the first time ever, closing the year around $105. It felt like the dream run would never end. Analysts like Jim Rickards and Peter Schiff were calling for $5,000 gold and $200 silver by 2027. But as we rolled into 2026, the party crashed hard. The euphoria blinded many to the overbought conditions, leveraged positions, and shifting macro winds that were brewing. The gold crash hit like a thunderbolt in late January 2026, catching even seasoned traders off guard. After kicking off the year with a bang, rising over 20% in the first few weeks amid renewed Middle East tensions and a brief dollar dip, gold touched an all-time high of $5,635 per troy ounce on January 29th. That's right, over $5,600 an ounce. To put that in perspective, it was more than double the price from just 2 years prior, reflecting the cumulative bull run. Investors were ecstatic, with safe haven demand surging amid ongoing U.S.-China trade frictions. Tariffs on semiconductors and EVs had escalated, and potential Federal Reserve policy shifts. Whispers of a weakening dollar fueled by U.S. fiscal deficits ballooning to $2 trillion annually added fuel. But then, in a matter of hours, some say minutes, the tide turned dramatically. Profit-taking kicked in as traders cashed out after the record highs, locking in gains from the 2025 rally. Simultaneously, reports emerged of a new Federal Reserve nominee, a former Goldman Sachs executive known for hawkish views, who advocated for tighter monetary policy to curb lingering inflation. This news strengthened the U.S. dollar index, DXY, by 1.5% overnight, putting immediate downward pressure on gold prices. The dollar's inverse relationship with gold is textbook economics. When the greenback strengthens, gold becomes more expensive for foreign buyers, particularly in emerging markets like India and China, which account for over 50% of global demand. This dynamic isn't new. It's played out in every major cycle from the 2011 peak to the 2020 surge. By January 30th, 2026, the current date as I record this, gold had plummeted to around $5,180 per ounce, a drop of approximately 7.6% from its peak, or about 8% as some reports from Bloomberg and Reuters confirm. That's a swing of over $428 per ounce in less than 48 hours, equivalent to losing the value of a mid-sized house for every ounce traded. But the real shock? The speed and scale. Markets were thin over the weekend leading into the week, with Asian and European sessions low on volume due to holidays, amplifying the volatility. Geopolitical risks that had propped up prices earlier, think escalating tensions in the Middle East with Iran-backed militias and Europe's energy crisis from Russian gas cutoffs, seemed to ease momentarily as diplomatic talk surfaced, giving bears the upper hand. Analysts are divided. Some, like those at JP Morgan, call it a healthy correction after the 2025 bubble, arguing that gold was trading at 25 times its 200-day moving average, a classic overbought signal. Others scream manipulation by big banks shorting the market to cover their massive short positions accumulated during the rally. Remember, gold isn't just traded on exchanges like the COMEX or LBMA. It's influenced by over-the-counter deals in London, futures contracts in Chicago, and even ETF flows from vehicles like SPDR Gold Shares, GLD, which saw $10 billion in inflows in 2025 alone. When institutional investors like hedge funds, think Bridgewater or Renaissance Technologies, start unwinding leveraged positions, it creates a cascade effect, where one sell order triggers algorithmic buying from counterparties, snowballing the decline. To understand the depth of this crash, we have to look at the broader context and the interconnected web of global finance. Gold's 2025 rally was fueled by a perfect storm. Beyond the central bank buying I mentioned, retail demand exploded in Asia, with India's imports hitting 1,000 tons as wedding seasons and festivals ramped up. Jewelry, which makes up 50% of gold demand, thrived. Inflation remained sticky, hovering around 4 or 5% globally, with core PCE in the US at 3.2%, making gold an attractive hedge against eroding savings. But entering 2026, the Fed signaled fewer rate cuts, maybe only 2 instead of the 4 anticipated, boosting 10-year Treasury yields to 4.5% and making yield-bearing assets like bonds more appealing than non-yielding gold. Add in a stronger-than-expected U.S. economy, with GDP growth projections at 2.5% for the year driven by AI tech booms and consumer spending, and suddenly, the risk-on trade was back in full force. Stocks rallied, the S&P 500 up 5% in January, crypto like Bitcoin surged past $100,000, and gold got sidelined as investors rotated into higher return assets. The crash wasn't isolated. It rippled through related assets like mining stocks, which dropped 10-15% in sympathy. Companies like Newmont Corporation saw shares fall 12%, while juniors like those on the TSX Venture Exchange tanked 20%, hurting exploration budgets. Now let's zoom in even closer on the mechanics of the gold crash, almost like we're inside the trading pits. Picture this. On January 28th, gold was trading above $5,300, with bars stacked in vaults around the world. Fort Knox, the Bank of England's depths, and Shanghai's free trade zone, gleaming under the fluorescent lights of trading floors in London, New York, and Shanghai. Traders were buzzing, screens flashing green as algorithms predicted further upside based on momentum indicators. By the 29th morning, it spiked to $5,594 on fresh buying from Polish and Turkish central banks, but then the reversal hit. A large block trade, rumored to be 100,000 ounces from a major sovereign fund, triggered the downturn, pushing prices to $1,509 intraday, a 5% drop that wiped out gains in seconds. Traders reported flash crashes in futures markets, where high-frequency trading algorithms triggered stop-loss orders en masse, creating a domino effect reminiscent of the 2010 flash crash. The COMEX in New York saw trading volume spike 300% above average, reaching 500,000 contracts, with open interest in gold futures contracts evaporating by 15% as positions were liquidated. This wasn't just retail panic, it was institutional firepower at play. JP Morgan, one of the biggest players with a $50 billion gold book, had been warning of overbought conditions in their research notes, predicting prices toward $5,000 by Q4, but cautioning on short-term pullbacks of 10-15%. Their proprietary trading desks likely contributed to the selling pressure, covering shorts profitably. The human element can't be ignored either. Behind the charts are real people whose lives were upended. Retail investors who flooded into gold via apps like Robinhood, eToro, and even traditional brokers during the 2025 boom were caught completely off guard. Many were first-time buyers, drawn by YouTube gurus promising easy money in a bearish stock market. Social media was ablaze with posts about the gold rush ending, and Reddit's r/Wall Street Bets even had threads debating if this was the big short moment for metals, with memes comparing it to the housing crash. One viral post from a user named GoldBug2025 lamented losing $50,000 on leveraged ETFs in a single day. Many had leveraged up, borrowing via margin accounts to buy at highs, only to face brutal margin calls as brokers like Interactive Brokers automatically liquidated positions. In physical markets, jewelers in India and the Middle East reported a sudden slowdown in demand. Cultural buying for weddings and festivals, which peaks in January, cooled dramatically as prices soared, then plunged, leaving artisans in Mumbai and Dubai with unsold inventory. Environmentally, the crash hurt gold mining stocks like Newmont and Barrick Gold, which tumbled 12-15%, delaying operations in Africa and South America. Rising energy prices, oil at 90 barrel, had already squeezed margins, and lower metal prices mean less incentive for sustainable practices like reforestation or water recycling in mines. But gold's crash was just the appetizer in this feast of financial turmoil. Silver's plunge was even more dramatic, amplifying the pain across the precious metals sector and underscoring the interconnectedness of these markets. Silver started 2026 on steroids, up 25% in the first 2 weeks alone, crossing $100 and then blasting to a record $120.46 per ounce on January 29th. That's a 298% increase from early 2025 lows around $30. Why the frenzy? Silver benefits from gold's halo effect. When gold rises, silver often amplifies it with a beta of 1.5 to 2, but it adds unique industrial demand that gold lacks. With green energy booming globally, the International Energy Agency projected solar capacity to double in 2026. Silver's use in photovoltaic cells alone was set to consume 150 million ounces. Electric vehicles need silver for switches and connectors, and the 5G rollout in Asia demanded more for antennas. Supply deficits were projected at 200 million ounces for 2026 by the Silver Institute, exacerbated by China's export controls on rare earths and antimony, which indirectly tightened silver availability through mining byproducts. Meanwhile, meme-driven buying from retail pushed it higher. Online forums organized bulk purchases echoing the 2021 Wall Street silver movement, with dealers reporting sellouts of American Silver Eagles. Then, the hammer fell with ruthless efficiency. By January 30th, silver had cratered to around $167 per ounce, a staggering 16.4% drop from its peak, or 11-13% as per broader reports from Kitco and Investing.com, marking one of the fastest corrections in history, rivaling the 1980 Silver Thursday crash. The smaller silver market, less liquid than gold with daily volumes about 1/10, magnifies moves. A few big sellers, like a commodity fund dumping 10 million ounces, can tank prices by 5% in minutes. Gold's drop added pressure, as silver often follows its bigger brother with higher volatility due to its dual demand profile. Industrial buyers like solar manufacturers in the US, First Solar, and Europe, SolarEdge, paused purchases, waiting for stabilization and hedging with futures. Speculators who bet on $200 silver by mid-year, as author Robert Kiyosaki predicted in his books and tweets, were left holding the bag, with many facing wipeouts on options trades. Delving deeper into silver's crash dynamics, consider the intricate supply chain that makes it so vulnerable. Silver production is largely a byproduct of other mining operations. About 70% comes from copper, lead, and zinc mines in Peru, Mexico, and Australia. So when base metal prices wobble due to Chinese demand slowdowns, silver output does too. In 2025, persistent deficits drove the rally, with mine supply flat at 800 million ounces, while demand hit 1.2 billion. But 2026's stronger dollar made U.S. exports pricier, hurting demand from Asia, where 60% of industrial silver is consumed. Manipulation allegations are rife here. Silver's history is littered with scandals, including the 1980 Hunt crash, where prices collapsed from $50 to $10 in days after regulators intervened, and more recent fines against banks like Deutsche Bank for spoofing fake orders to manipulate prices. Some analysts, like those at CPM Group, warn of bubble dynamics with prices detached from fundamentals. Silver's gold-to-silver ratio hit 45.1 at the peak, historically low and signaling overvaluation. The COMEX silver futures saw similar flash events, with prices swinging $10 in minutes as stop losses cascaded. Retail platforms like SD Bullion reported a surge in sell orders as influencers who hyped Silver Squeeze 2.0 on TikTok and YouTube faced backlash from followers demanding refunds on premium price bars. Now the big question you've been waiting for: how much was wiped from the market when combining the gold and silver crashes? This is where the numbers get jaw-dropping, and I'll walk you through the calculation step by step to ensure transparency. To calculate the total value lost, we look at the drop in price multiplied by the total above-ground supply of each metal, as that's the investable stock representing global wealth tied to these assets. Above-ground supply includes all mined metal that's not lost or in landfills. It's the total float that prices are based on. For gold, the total above-ground supply stands at approximately 216,265 metric tons, as estimated by the World Gold Council. Converting to troy ounces, 1 metric ton per 150/75 ounces, that's about 6.95 billion troy ounces, with the price dropping $428 per ounce from 5,608 to 5,180. The value erased from gold alone is roughly $428 multiplied by 6.95 billion, which equals 2.98 trillion. That's trillion with a T, more than the GDP of many countries like Australia, 1.7 T, or Spain, 1.5 T, and roughly equivalent to the market cap of tech giants like Apple at its 2025 peak. For silver, the above-ground supply is estimated at 1.74 million metric tons by the Silver Institute, or about 55.94 billion troy ounces, using the same conversion. The price plunge of 19,079 per ounce from 120.46 to 167 wiped out approximately 1979 multiplied by 55.94 billion, equaling $111 trillion in silver value. This calculation assumes the full stock is valued at market price, which is standard for assessing total market capitalization. Combining the two crashes, the total market value swiped is a staggering 2.98 T, plus 1.11 T, somewhere $4.09 trillion. That's right, over $4 trillion vanished in a blink, aligning with reports of $3+ trillion wiped in minutes from futures markets and even $6 trillion in broader estimates when factoring in derivatives, leverage positions, and related assets like mining equities and ETFs. This isn't just paper losses, it's real wealth destruction. Pension funds like CalPERS with billions in metals exposure saw portfolios shrink overnight. Sovereign wealth funds in the Middle East and Norway faced markdowns, and individual investors, think the average 401k holder with 5% in commodities, lost thousands. The gold market's total value at peak was around 39 trillion, 6.95 BOZ 5608, and silver is about 674 trillion, 55.94 BOZ and 120.46. So the combined peak was over 45 trillion, now down to about $41 trillion, confirming the 4T hit. To verify, consider ETF holdings. GLD alone lost $15 billion in value, while silver ETFs like SLV dropped $8 billion. This combined wipeout has profound implications that extend far beyond the trading screens. Economically, it signals a major shift. From the fear trade that dominated 2025, where investors fled to metals amid uncertainty, to a risk-on environment in 2026, potentially boosting stocks and bonds but hurting emerging markets reliant on commodity exports. Countries like South Africa, Peru, and Ghana, where mining contributes 10 to 20% of GDP, could see currency devaluations and job losses. In India, where gold is not just an investment but a cultural currency, stored in temples and passed down generations, jewelry demand could slump by 30%, affecting 300 million livelihoods in the artisanal sector, from designers to polishers. Environmentally, lower prices might slow sustainable mining investments. Companies could cut back on eco-friendly tech like electric haul trucks or biodiversity offsets, exacerbating issues in the Amazon and Congo basin. Geopolitically, central banks may double down on buying dips, as seen after the 2020 COVID crash when purchases surged 20%. Russia and China could accelerate their gold hoarding, further challenging the dollar's dominance. Was it manipulation? The debate rages, and it's worth unpacking. Some say yes. Big banks like HSBC and JP Morgan have faced multi-million-dollar fines for spoofing and front-running in precious metals markets in the past, as revealed in CFTC investigations. The suddenness of the crash, with thin liquidity over the weekend, raises eyebrows. Volume spikes suggest coordinated selling, possibly to cover short squeezes from the rally. Conspiracy theorists on platforms like Zero Hedge point to the London fix process, where prices are set daily and allegedly manipulated. But fundamentals played a significant role too. Over-leveraged speculators, COMEX data shows net longs at record highs, faced forced liquidations, Fed signals on rates tightened sentiment, and profit-taking was inevitable after 63% gains. History shows crashes follow booms. Silver's 144% 2025 gain screamed correction, much like the dot-com bust or 2008 financial crisis. Looking ahead, forecasts vary wildly, adding to the uncertainty. Bullish analysts like those at Gold Switzerland predict gold could rebound to $6,000 by late 2026 if a recession hits, triggered by Fed over-tightening and unemployment rising to 5%. Silver might hit $100 again or even $150 if industrial demand from EVs surges with policies like the U.S. Inflation Reduction Act extensions. Bearish views from Citi suggest further drops to $4,500 gold and $80 silver if the dollar strengthens to 110 on DXY and global growth exceeds expectations. For investors, my advice is clear. Diversify across asset classes. Don't put all eggs in metals. Avoid chasing highs. Dollar cost average into physical holdings like coins or bars over paper ETFs, which can be vulnerable to counterparty risk. Monitor key indicators. Fed minutes, dollar index, and geopolitical headlines. Tools like TradingView for charts and Kitco for live prices are essential. In conclusion, the gold and silver crashes of 2026 wiped $4.09 trillion from the market, a stark reminder of volatility's bite in an interconnected world. This event isn't just a financial footnote, it's a lesson in hubris, timing, and the fragility of markets. Whether you're a seasoned trader or a newbie, understanding these dynamics can save you from the next big drop. Stay informed, stay cautious, and remember, knowledge is your best hedge. Hit subscribe now for more breakdowns and drop a comment below. Did you get caught in the crash? This is Alex signing off.